Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the price-earnings ratio. We're going to have a comparison for two companies with different amounts of leverage. In other words, they're going to be the same in that they're going to have the same operating income as well as the same amount of assets, but there's going to be a breakout that will be different, one being financed through debt more, the other being more financed through the issuance of common stock, the issuance of equity. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 528 price-earnings ratio comparison for companies with different leverage tab in the practice problems section. Going to be closing this back out. We're going to read through the data that we have up top, then we'll have a smaller component of that data we will use to work through the practice problem. So we're going to have two scenarios, A and B, and we'll take a look at the differences between these two. We have the earnings before interest and taxes will be remaining the same. This basically being operating income. If you're thinking about the income statement, basically operating income before we deduct the interest, before we deduct the taxes, they're the same at that point. And then we have the debt, which for company A, they're going to have more debt. The $850,000 versus $290,000 for B, same tax rate, which is going to be 14%. Then we have the common stock section where there's a difference here. Now B has more of the common stock. So you can see one is basically financing their assets with more of debt, the other with more of the equity. And then the equity for A, the 575, then the shares are going to be here. We're going to be calculating the earnings per share, and then we have a tax rate of 25%. Again, the same for both companies. The price to earnings ratio, or PE ratio, we're going to start off with the same PE ratio, meaning 21%. So we're going to use the earnings per share to then calculate the market price with the PE ratio, assuming the same PE ratio. And then we'll take a look at this with a differing PE ratio, and we'll discuss maybe why there might be a difference in the PE ratio, even though there's going to be similarities between these two scenarios, between these two companies. First, let's just take a look at the difference between their kind of capital structure, how they're paying for their assets. What's going to be the structure of this? We're going to say, all right, if we look at our accounting equation for these two companies, assets equal liabilities plus equity, we could say that we're given here the liabilities and the equity in essence. So if I look at company A, then we've got the liabilities of $850,000. We have the equity of the $575,000. That's going to give us the total assets then, if we add them up, assets equal liabilities plus equity, of the $1,425,000. If we contrast that to B then, we see that B has liabilities of the $290,000, has equity of the $1,135,000. If we add the $290,000 and the $1,135,000, we get the $1,425,000. We have the same amount of assets for both of A and B. However, the structure of those assets, the financing of those assets differs. A financing more of them with debt, B financing more with equity. Now, there's pros and cons to either kind of method that you will be financing for, but you can see that there's going to be similarities in the number in the assets of the company and with the operating income difference in the financing structure. When you're thinking about financing your company, then you got to think about, how are you going to do it? If you need to have more assets in order to generate more revenue, you can either do it with debt, which has its pros and cons, which we'll see more as we go through this. One of the cons is that, you have to pay interest on the debt, obviously, and it's going to increase the risk in case there's a problem and you can't pay the debt, that could, lead to bankruptcy in the case of decline in the economy. The other way is you can have equity, but with giving equity, then you're giving up some of the earning potential of the company as well. So if you're selling an equity investment in the company, so they have then voting rights within the company. The new shareholders are going to have voting rights in the company and rights to the shares of the earnings of the company. So there's going to be pros and cons between the two options. Let's take a look at it in terms of the income statement. So we'll kind of break out the income statement starting at the point at which they're the same, which is basically towards the bottom of the income statement, earnings before interest and taxes, meaning we're at kind of like net income before we take out the interest and the taxes. At that point in time, they are the same. They have the same revenue or similar revenue structures minus the expenses, same in terms of those items. And now we're at the operating income, or earnings before interest and taxes. So they're at the 170 for both. Now the interest then is going to be different between the two, of course, because one company financed with debt and the other financed through equity. So the one with debt then is going to have more interest that's going to be due. So if we calculate the interest for A, we've got the 850,000 times 0.14. That's going to give us the 119,000. And B, we have the 290,000 times 0.14. It's going to give us that 40,600. So A then has more interest that's going to be allocated to it. That's going to give us our earnings before taxes now, which will, of course, differ due to the difference in the amount of debt that is outstanding, even though we started at the same point with the operating income. So the earnings before taxes now at the 51,000 for A versus B, the 129.4. So that makes, obviously, the B look better in terms of the income. Now, when could this be good for someone having lower earnings before taxes? Well, that means the taxes are going to be lower, because the taxes are going to be based on the earnings, and we basically got to deduct the interest. So if we think about the taxes, they're at 25%, then we calculate the taxes, we would just take, all right, where's the 51,000 times 0.25? And you might be thinking, you can't really just apply a 25% tax rate. Just note that when we think about that 25%, we're not just taking it from the tax return. We're having to try to figure out what the tax rate would be that we can apply to the earnings before taxes. So it's not like we're just taking, a tax return because there's a progressive tax rate and, there's tax credits and whatnot. We have to take those into consideration to think about what the tax rate would be that we can apply here. So we're going to assume that we did that, and we have the 25% tax rate here. That's going to be the 12,750. And over here, and by the way, we do talk about that, how you get to that tax rate in advanced financial accounting, if you're interested in that. So then we have the 32,350 times the 0.25, and that's going to give us, let's do that one more time. We got the 129,400 times the 0.25, and that's going to give us the 32,350 on the taxes. Then if we were to subtract out the earnings before taxes minus the taxes, we're going to get the earnings after taxes of the 38,250 and the 97,50. And so that's going to be basically our bottom line. So we ended up kind of diverging between A and B from the point in time that they had the operating income, because we're assuming they're basically identical up until that point. And that's due to the difference in the financing structure, one with debt, the other with the interest. Now that we're at the bottom line of the net income, or earnings after taxes, we can now think about the earnings per share. So we have the shares outstanding for A, 115,000 versus the 227 for B. B has more shares outstanding because they financed more of their assets, not with debt, but with equity by issuing more shares. So they've got more equity out there. So that's going to be where they finance more. They got more shares, the 227. So now if we were to divide out and get the earnings per share, then we're going to be picking up then the 38,250 divided by the 115. These are the number of shares that are outstanding. That's not the number of, that's the owners. But notice, of course, one owner can own multiple shares. So we're breaking this out to a per unit component. That means we have 0.33 per share, 33 cents per share, versus the 97050 divided by the 227000. That's going to give us the 0.42, or about 42% or 42 cents per share on B's side of things. Okay, so now let's consider what the stock price would be with our PE ratio. So remember what the PE ratio is. It's going to be just what it sounds like, the price divided by the earnings. And when we talk about earnings, we're talking about basically earnings per share, the price compared to the earnings per share. So how many multiples of the earnings per share is basically the market price. As we consider this, remember that the market price has nothing to do with the internal data that we have just done here. The market is determining what the market price can be. And we'll then try to figure out, well, why would the market value the price as it is? Why would it be trading on a market, on a free market where people are making exchanges? Why would it be, what it is on basically the market? That's what we're trying to kind of determine when we're thinking about the market price. So we got the earnings per share of the 0.33 and the 0.43. then we're going to have our price earnings ratio. We're going to assume that it was the same. So we're given the price earnings ratio. We're assuming it's 21 for each. We got the same price earnings ratio, which if we know the earnings per share and we have the price earnings ratio, that's the multiple of the earnings per share that's going to get to our stock price. So in other words, we're going to take that 0.33 times 21, and that's going to give us about 6.98. Now, it's not exact because there's rounding involved, so you'll recall that we really had 38,250 divided by 115,000. It's really 0.3326 and so on, times 21 would give us the 6.98. And then we have the 0.43 times 21 is going to give us about that. And let's do it more exactly. We got the 97,050 divided by 227,000. It's really 0.42753 and so on. So let's take that times 21, and then we got our 8.98 about. So that's going to be our stock price. Remember that if you're given, for example, the stock price and the earnings per share, and you're asked to calculate the PE ratio, then you would say, okay, well, now I've got the stock price, the 6.98, and divided by the 0.33 earnings per share. That means that the price, the PE ratio would be 21, meaning there's 21 times the earnings per share is what the PE ratio, or the price of the stocks are trading at 21 times the earnings per share. Okay, so now we can consider, so you can see how we have this difference then, of course, in the stock price, and we have these differences up top, even though we have the same amount of net income, or earnings before interest and taxes, operating income, due to the difference in the capital structure. So so we have these differences that happen here due to the interest and due to the difference in shares, and then we're going to have the difference even when we use the same price to earnings ratio, PE ratio, in the stock price. Now you might consider then, you might say, well, if you're thinking about the stock price, the stocks are probably, if you're trading the stocks and their stocks are trading, then the stock market might be more concerned than with the higher leveraged company. Meaning, if you look at these two companies, you might be more concerned with the company that has more debt that is outstanding, because if there's a problem, if there's a downturn in the market, they're going to be taking on the more risk. So from a trading standpoint, you might expect then the PE ratio to be favoring over here on B side of things, basically the stock price possibly being higher on B side of things, even though they have the same number of assets and they have the same earnings here, due to the difference in the capital structure of the breakout between the liabilities and the equity, how they financed the assets. So you might consider, if we had a separate PE ratio, it might be that if we got the same 0.33 and 0.43, you might see the market saying, hey, the PE ratio is really going to be 17 compared to the 21, because there's going to be more favoritism towards B, which is going to have less risk being taken on due to having less leverage in financing with more of the equity, and that would result in in the stock price is of a more deviation in the stock prices, the 5.65 versus the 8.98 about. So that would be the let's just do it real quick here. If we took remember the rounding, 0.33 times 17, that's going to give us the 5.61 about. If we wanted to be more exact with it, we would be taking the 38250 divided by the 115000. It's going to give us the 0.3326 and so on times the 17. That's going to give us our 5.65, and we could do the same here for B.